Good evening, everyone. I'm Larry Kudlow. Welcome back to Kudlow and Company. We aim to be right on America, right on business, and right on the money. And yes, we still believe that free market capitalism is the best path to prosperity. On this evening's program, stocks were flat today. The Dow and the S&P 500 up slightly, the Nas off a bit. But inside the indexes, the 10% decline since last October 9th has recession correction written all over it. Now, I am not buying the recession scenario, and I still think it's a great time to scoop up stock market bargains in order to invest in the long run. But here to tell us what they think are Kenneth Hebner, top-ranked U.S. stock fund manager for the second quarter in a row, according to Morningstar. He manages the 5-star CGM Focus Fund. This thing has been gangbusters. It was up about 80% last year. Wow. Jerry Bowyer, chief economist, Benchmark Financial Network, and columnist for National Review Online. CNBC contributor Morris Reed is managing director of Weston Reinhardt. And our housing bear, the president of Gary Shilling and Company, regular columnist for Forbes magazine, Gary Shilling, sinking slowly into the West, although you got to hand it to him. His view is prevailing on the housing-related downturn. Gentlemen, welcome back to Kudlow and Company. Ken Hebner, I can't thank you enough for coming on. Ken, let me just ask you right off the top in brief, bullish or bearish? Rocky start early part of the year. I'm going to walk through some sectors in a minute. Unfortunately, they're all the cyclical growth sectors. Where do you think this thing's going, Ken?
Well, I mean, never make predictions on the market, but I think there's opportunities. What happens is if we have a recession, I don't think we're going to have a recession in the United States. You look at the key numbers, it got a little bit close. The ISM Purchasing Managers Index, so I got to 47 for December, but below 45 is viewed as a recessionary level. But the rest of the world is strong, and there's no sign of the diminution of the growth in the emerging markets. Europe is still growing, although very slowly. So I think it's time to continue to look for opportunities in those parts of the world economy that are growing.
Ken, you get worried. Let me just ask you, don't mean to cut you off, but let me just say on that last assertion about the rest of the world, both the emergings and the developing. All right, year-to-date, S&P off 4%. No, S&P is off 6%. The Dow is off 3.3%. NASDAQ is off about 5%. But let me ask you, when you look around the globe, Europe is off 3.5%. Asia is off 4%. Latin America is off 6%. The emerging markets in general off 3%, Ken. I mean, it looks like it's simpatico.
Well, sure. The last week, things have gone down, and as you point out, we're down over the last quarter in terms of the markets. But when you're investing, you have to look at your fundamentals, and you have to look at the values, and you have to look at how those fundamentals are going to evolve over the next year or two. And when I see situations where the fundamentals are going to be strong, and where the valuations are reasonable or cheap relative to what I think is going to evolve, I don't worry about what all these markets are doing. I look at the individual stock. And in fact, that's what happened in 2007 in our portfolio. The market didn't do a lot, and there were a lot of problems in the world, but we had 5 stocks up over 100%, which really related to specific things that were happening in specific countries and specific industries.
Gary Shilling, you have been right. You have been a bear. You are still a bear. You've been talking recession. You've been talking housing. You've been talking very low bond rates as part of the recession scenario. My hat is off to you in some metaphorical sense, though I'm still not in the recession camp. Where do we go from here? In particular, you have stock picks. You have the recession scenario for investors. Give us some highlights of your stock picks.
Well, the best one I have is long Treasury bonds, and this isn't for wimps and widows and orphans. This is for appreciation, because I think we're going to 3% yields on the long bonds, as you and I have discussed this many times. And if you do from here on a 30-year bond, coupon bond, you'll make about 30% on your money, and a zero coupon, a zero coupon 30-year Treasury, you make about 50%
10
on your
years.
money.
10 years closed at 384 today. So you think they're going to 3%? No, actually, you'd have a 10-year under 3%, wouldn't you?
It'll probably be a fairly flat yield curve, but they could be under 3%. Now, that's assuming we have a major recession, and then we do have some chronic deflation on top of that.
What's the hot stocks for a recession scenario? Is that the hot stocks for recession? I don't know. I've got to get used to this, but go ahead.
It's really what you don't want to own. Nothing that's housing related, and that includes your own house. If you're thinking about selling, you ought to do it yesterday. It means consumer durable goods, things that are discretionary, people can do without, like cruise lines and autos and appliances. Those things you ought to avoid. There's been a lot of speculation beyond subprime mortgage. That was the first to go because it's the most vulnerable, loans to the least creditworthy borrowers. But you've had speculation in emerging market stocks and bonds. You've had it in junk bonds. You've had it in commodities. There's a lot of these other areas.
So stay out of that stuff. Yeah. Stay out of all that stuff. Stay out of commodities,
and if you're like
for example.
me, you want to be short those things.
Is there any affirmative stock picks? Any stocks you like?
Well, there's a dollar. The dollar, I think, is going to be attractive.
Ooh.
Yeah.
Ooh.
Yeah, because this is going to be a global recession. It'll spread abroad with the usual lag of about 6 months. It's starting here now. You'll see it later. And then the dollar, I think, will be the safe haven once again. And everybody is negative on the dollar, which tells you it's probably way overdone.
All right. Jerry Bowyer wants to bring you in. We have a chart up from the Carpe Diem blog site of Professor Mark Perry that shows the distribution of mortgages. It's very interesting. Yeah. 55%, more than half of American households, are either renters or have no mortgage at all. I find that very interesting. 34.5%, Jerry, have prime mortgages. They're not in any trouble. You got to go all the way down the list. 3% own subprime ARMs. That's where the big issue is. And so far, Henry Paulson's negative speech today notwithstanding, the foreclosure process is still less than 2% of total mortgages. Jerry, are we headed for a recession? Is Shilling going to get it right, or is he going to lead us right to the water's edge, but we'll never drink?
We are not going to have a recession. Shilling is not leading us to a recession. He's not going to get it right. He was right about housing, but for the wrong reasons. So let's get the right reasons, and then we'll see where we're going.
Wait a minute. I challenge you on that. I had this right for the right reasons. I said the subprime thing was going to sink the ship, and it did. And I said it was because of loose lending practices, low interest rates.
Even though it's a small ship. Let's put that chart back up on the screen.
I challenge you on that. I think you're dead wrong.
Let's put the chart back up on the screen.
Gary,
you got to go all the way down the list. 1, 2, 3. The fifth category is subprime adjustable rate mortgages. But look, the bulk of
they were 20% of the issue last year.
So
they've been growing. It doesn't matter what's outstanding. They're about 12% of what's outstanding. And the point is, you take out that lower end of the spectrum, and then the guy with a starter house who's going to sell it to a subprime borrower and move up to the next notch can't, and on up the line. The move-up market is killed.
They sunk the dinghy. That's about it. No ships were sunk in the making of this story.
Well, why are stocks down?
Jerry Bowyer, what's your...
Why is the housing thing in shambles?
Hang on.
Why do you got all these write-offs from Wall Street? If you say this is nothing.
Order. Jerry Bowyer,
yes.
What is your outlook and why?
My outlook is the problem was a credit problem from the beginning. The Fed was too tight. This was not subprime mortgages causing all this problem. Subprime mortgages were the canary in the coal mine. They were the first to suffer from the excessive tightness of the Fed. The Fed is dealing with that excessive tightness, which is why the TED spread is narrowing like crazy and LIBOR is coming down, and why the Fed funds effective rate is where the target rate is. So all that stuff is getting solved, and so since that was the cause of the problem and it's being solved, then we won't have a recession.
We do have some charts to show that these credit spreads have narrowed in the money market.